Okay, today's bank is USCB Financial Holdings. They're based in Florida. So most of their banking centers are in South Florida, I believe. So the interesting thing about this bank is that they just had their IPO in 2021. I believe it's been operating since 2002. So, although the bank has been in place for a little over 20 years, they just recently created the holding company, USCB Financial Holdings, to hold the bank, and have now had operations for about 3 years or so. And so if we come over to Yahoo Finance, you see over the past year, the bank has had the ups and downs that we normally see when we're looking at a one-year chart for a community bank, although the past quarter has been a really big run-up. So the price has gone up by a lot. Several of the banks we look at, the price has stayed down at this area. So they've had a really big run-up in the first quarter. We actually ended up buying the bank about a year ago, and since then I believe it's had up about 20% or so. So it ended up being a pretty good buy. Back then it was at a pretty good value and pretty good risks, and we felt pretty good about it, so we bought it. But now we can see, do we think that it's still a good buy at this increased price? So as we can initially see, the market cap about 250 million. That's a really small bank in our population. Most of our banks are somewhere between 600 million to 1.8 billion in market cap. So this one is below the normal range of size. The PE ratio about 16 times. That's really, really high. We usually like to see it around 10. And dividend yield, so that I think they just recently started a dividend. So, since the IPO began in 2021, they didn't have a dividend there for a while. I think they were a little undercapitalized, but in the past year they decided to institute a dividend at 5 cents a share. So that's where we get the 20 cents here for a year, quarterly dividend of 5 cents. So a little bit of a lower yield, but not too bad, considering the company's new to the exchange anyway. So if we come to the statistics, we can see a little bit more about the valuation. Price to book 1.29. That's not too bad. This is a little on the high end. Most of our banks are somewhere between 0.9 and 1 times price to book. So it's a little bit on the high end. Profitability, so the return on assets, 0.66%. That's pretty low. Same for the return on equity. So, just taking a quick glance at these ratios without knowing anything else, we can see that, maybe the bank is, its profitability is a little bit lower than the average bank, and maybe is priced a little bit higher than the average bank, at least relative to earnings, 16 times, and relative to the book value of the assets. So, once we dive in a little bit, we'll be able to see, does that make sense? Does that still make it a worthwhile buy, or is this something we should just move past without buying? So let's start diving in. So coming down to the balance sheet. All right, so at first look, we've got about $126 million of cash. That's about 5%. That's pretty much in the average range of most banks. And we've got about, if we added these together, for held to maturity and available for sale security, it's about 433 million. And in total, as a percentage of the assets, that's about a little over 17%. So that's within an average normal range, maybe a little bit on the high end of the range. So I would say with the average amount of cash and an average amount of securities, they've got a pretty good liquidity position here with on-balance sheet liquidity. And then about $1.8 billion of loans, and that's about 73% of assets. So that's pretty much an average as well. So the asset side of this balance sheet is a very average bank. So looks like pretty good liquidity, but also a pretty good amount of loans to give them a good yield on the assets. So in the income statement, I would expect pretty average interest income as well. So if not, maybe a little bit on the higher end of the average. So that's good. And then on the liability side, we've got about 577 million of non-interest bearing deposits, or demand deposits. And that's actually on the that's higher than our normal range. So they've got a lot of non-interest bearing deposits. And then the interest-bearing deposits as well as the debt comes into about a normal average range for a bank. So, I would expect that, maybe the interest expense would be pretty average, if not on the lower end of the average, since they've got about a higher amount of non-interest-bearing deposits. So it's a little lower cost of funding here. Most of their debt comes from FHLB, which can be 5 to 5.5% or so, depending on the timing of things, but and the duration. But as it is, maybe they've got a pretty good average yield on their liabilities. So, and on the equity side, we can see they've they used to have a lot of different types of securities. But as they came out in the IPO, all that stuff got converted, and so now they've got common shares, and that's it. So we can see 0, 0, 0, 0 outstanding. So if we looked at the leverage of the balance sheet, that gets us about 13 times assets to equity. And that's pretty high leverage amount compared to most banks, a little bit higher. So they've got a little bit more leveraged, and part of that's probably due to they did the IPO in 2021. So since then they've accumulated a lot of OCI from when interest rates went up, then the securities values went down, and so a lot of that is encapsulated in that, which we can also kind of see here. Also they're trying to get, rather than retained earnings, they have an accumulated deficit here, so trying to, turn that around. So even though they've got a pretty good liquidity position, there could be some circumstances where they, the capital itself from an common equity standpoint might be inadequate, but we'll look into that in more detail once we kind of look at the fair values of the net assets and some of the regulatory capital ratios and all that. So, all right, so getting into the income statement, we've got about $31 million of interest income. It's about 5.22% of assets. That's pretty average. It's sort of what we're seeing for most banks currently. And then we have interest expense of almost 16 million, and that represents about 2.79% of assets. That's a little bit on the high end of what most banks are presenting on their quarterly reports at the moment, but it's not too egregiously outside the range. So that results in a net interest income of 15 million, which is about a 2.41%, and so that's pretty low. We're normally looking for somewhere around 3%, so 2.4% is a pretty low net interest income, and I guess it's mostly due to the interest expense being pretty expensive. It's really the deposit side of things that is so expensive, but we'll be able to look into it a little bit deeper once we kind of see some of the yields. But as it is, just on a net interest income basis, we would, immediately conclude that maybe they're not as profitable as what most banks are currently. Looking at the non-interest income, they I believe they have a title company that they discuss down here. Yeah, Florida Peninsula Title. So maybe they get some fees out of that. When it comes to $2.5 million, which represents about 8% of revenue, that's below the normal range that we see. So they're not earning as much in non-interest income as what the average bank is currently. So that might, reduce their profitability from what we would see the average bank to be as well. Non-interest expense is about 11 million, and that is about 33%. That's a lot less than most banks. So, most banks somewhere, above 40% for the non-interest expense in most cases. So, all that together gets us about 4.6 million of net income, and that's about 0.79% return on assets. That's pretty low. We're normally looking for 0.9 to 1.10%, something like that. So, due to the higher interest expense costs, as well as, not really enough non-interest income, they've got a little bit lower profitability than what most banks have. So that's unfortunate, but we can go and look through the income statement and see, or the footnotes, and see why that is. But first we can see, all right, 4.6 million divided by 250 million market cap. That gets us about 7.3% earnings yield, and that's below the range we're looking for. We're usually looking for 9 to 11% at least. So 7.3. The stock price really hasn't come down to support this lower profitability here. So as it is, it looks like from a profitability standpoint, it might be a little bit too expensive, but we'll know a little bit more about things once we dive into the footnotes. So here we go. Getting past some of the accounting policies, we can get into the investment securities. As we see with most banks, most all of it is mortgage-backed securities or some kind of collateralized mortgage obligation, and it represents about 74% of the securities. So those come with the implied or explicit government guarantees. So pretty much low risk securities portfolio. For the other stuff, they've got some U.S. agencies, a little bit of corporate, a little bit of municipals. So they talk about it here in the footnotes about how there's some unrealized losses here, but it's not due to credit quality. They say it's due to market interest rates, which is pretty common for most all banks here. So there's not really an allowance for losses, so to say, but it's pretty low risk portfolio that they have, and it's very common for the securities portfolio that most banks have in place at the moment. But so moving on, we can look at the loans. We can see the majority of the loans come from commercial real estate. So about a little over 1 billion are commercial real estate loans, and that represents almost 60% of the loan portfolio. So a lot of the characteristics of the risk and returns are going to come from commercial real estate. They've also got a little bit higher allocation to consumer loans than what we might see for most community banks. So consumer loans tend to get a larger larger yield, but they've also got, a higher risk there, stuff like, vehicles or even personal loans type of thing. So anyway, so it looks like, we're more allocated toward more of the riskier, but higher yielding um, loans, and lower allocation to residential real estate, C&I, than what we might see from most banks. So diving into the ACL, the allowance for credit losses, we see it's about 21 and a half. It's about 1.18% of loans, and that's pretty average. It's pretty much right in the middle of the range of how much most banks have reserved for. So 1.18% of the loans. And we can start diving into a little bit of the credit quality indicators. So we're looking for the classified loans, those that are ranked substandard and below. And if you were to add all these up, including the commercial and the consumer base, it would get us about 8.1 million. And that's a really, really low amount, 0.45% of the loans that are outstanding. So, you could say that since a lower amount are classified, the loan portfolio perhaps is a lower credit risk than what we might see in most banks. So they've got an average ACL allowance or average allowance, what we see of most banks, but the credit quality of the loans that they have in their books is superior. So it seems like that they, just based on this, they would be really well reserved, a very conservative reserve. So that's great. In addition, we can look at the loan aging. So we can see that they've got about 13.4 million that's accruing and past due, plus about 500,000 that is non-accrual. So that 13.9 million that we consider past due, it's about 0.76% of the loans portfolio, which is in an average range. It's a little bit high at the high end, but it's pretty average for what we see for most banks currently. And we can see most of it comes from the residential real estate, which is interesting. But yeah, so an average amount is past due or non-accrual. Only 500,000 is non-accrual. That's super, super low. And then no collateral dependent loans as well. Modifications was only 500,000. So I feel like they're really well capitalized. At least their reserve, they have a really robust reserve compared to the credit quality, because their reserve is about average for most banks, but the credit quality of their loans is superior than most banks. So I feel like that they're just really conservative with the reserve, which is great. So carrying on. So looking at the derivatives, they have some cash flow hedges with a notional amount of $50 million that's hedging the certificates of deposit, which is great. I like to see that they hedge the liability side of their balance sheet from a cash flow perspective, because it fixes the interest expense. So if interest rates were to go up, their interest expense would stay the same. They wouldn't be affected by the higher interest rates. They also have some fair value hedges, 200 million that's hedging the fair value of the loans. So that I think is very beneficial as well, because it's basically allowing its loans to float, at least 200 million of them. So if they have some fixed asset loans or fixed rate loans, and interest rates go up, then they get to participate in the higher interest rates and earn more on those loans, which is great. I think at least in this environment. But it's a pretty small amount, 50 million, 200 million. When we're looking at, they've got 1.8 billion dollars of loans. It's a pretty small amount, but helpful for interest rate risk. And whenever we look at the interest rate risk, we plug this 50 million into 200 million in our repricing calculations to see, because whereas this 50 million would have repriced, since these swaps are in place, the 50 million of certificates of deposit would have repriced, but since that 50 million of swap is in place, it's not going to reprice. So we kind of take those things into account when we're making those calculations, but we'll get into that further down as well. So fair value measurements, we can compare the fair value of the assets on the books to the fair value of, or we can compare the fair value of the assets and liabilities to what they have it at on the books, which in most cases, the differences would be the held to maturity securities, which are carried at amortized cost on the books, as well as the loans, and then probably some CDs like the time deposits, which have set maturity dates, but interest rates might have changed since they issued those. And then also, FLB advances, a small difference. So if we converted all of its balance sheet to fair value, it would reduce the net assets by about 53 million, which is about 27% of equity. And that's about pretty normal for what we see in most banks when we're converting things to fair value currently. So, we use this, not only for a valuation perspective, but also from a capital adequacy standpoint. Do they have enough net assets to support, its assets and deposits and stuff? So whenever we convert everything to fair value, and look at the net assets, which would be the assets minus liabilities, it's the equity essentially. So the fair value of the equity compared to the fair value of the assets, we get about a 5.82% ratio, which is pretty much in the middle of where most banks are currently. So it's the fair value of its equity is about 5.82% of the fair value of its assets, which is an average bank, so I feel like it's adequate. If we were looking at this from a valuation standpoint, it's fair value of its equity, so it's assets minus liabilities at fair value. The market price compared to that is about 1.77 times. So you'd be paying, the current market price, you'd be paying 1.77 times the fair value of its net assets. Fair value of its equity. So basically a price to book ratio that's converted to fair values. And 1.77 is pretty much in the average. So it's about an average price to pay for a bank, maybe even a little bit on the lower end of a range, of the average range that we see. So, pretty reasonable price for the net assets for an average bank. So keep that into consideration as we keep going along with the risks. But as it is, the capital adequacy seems to be adequate. The price on its net assets seems to be reasonable for an average bank as well. So, and another cool thing is that they just issued, or the board just approved 500,000 shares to be repurchased. So I think it discusses it somewhere else. It must be down in the MD&A where they talk about, they instituted another 500,000 shares. So 500,000 plus the 73,000 that's remaining as of March 31st are available or have been approved to be repurchased. So that represents, it's about 3% of the shares outstanding. So that's pretty average for most banks. So it's good amount of shares to be repurchased. And then, also we talked about they just instituted the dividend program. So you're also getting, 5 cents per share per quarter. So, giving a lot of excess cash back to shareholders, which is great. Yeah, so this is where they talk about, the dividend policy. And coming on down, oh, here we go. I was in the subsequent events section. So yeah, they did a new directive of 500,000. So that means that they've got 573,000 that's they're planning to repurchase, or at least been approved to be repurchased. So, all right. So jumping down into the MD&A, we can look at some of the yields. And to reiterate some of the statistics we were looking at, net interest margin 2.62%. That's pretty low. You can see last year in the same quarter they had a net interest margin that's in the range we like to see, but this year it's a little bit lower, which is kind of hurting their profitability. Efficiency ratio is 63%. That's pretty much average, so not too bad. But last year was a whole lot lower. Lower the better for an efficiency ratio. It's basically the non-interest expenses divided by the revenue. There's a few other nuances to it, but that's essentially what it is. So we want it as low as possible, but this is in pretty much an average range. So all right, so we can look at some of the yields here. We can see that interest earning assets 5.34%. It's a good amount. It's about average, or a little bit on the higher end of the range. So earning pretty good money on the loans, at least 6.01%. That's a little bit on the higher end. Investment securities kind of on the lower end. It'd be nice if they could earn a little bit more on the investment securities, but it's on the lower end. So anyway, 5.34%, about average for this time period. The interest expense side, a little bit higher, so 3.86%. We've been seeing somewhere between 2.25% and 2.75%. So it's a little bit on the higher end. You can see it's time deposits. These yields are a little bit higher than what they've been a year ago. So that's giving them a pretty low net interest margin, which is kind of eating into the profitability of what we might expect. They also have a pretty low non-interest income we talked about earlier, a pretty low non-interest expense, which doesn't help to mitigate the net interest income lacking, unfortunately. So we already looked at the securities and the loans in detail. One of the things we can think about is a lot of the securities reprice after 10 years, which would be a risk for interest rate repricing, but it's pretty common for what we've been seeing for most banks. It's just really far dated securities. As we saw the average yield on their securities, 2.71%, 1.92%, that's really low. So they're basically stuck in those yields for, over 10 years. So that's not good. Eventually they might end up selling them to reinvest in higher yielding securities, which would probably be a good plan. But at that time, all the embedded unrealized losses will hit the income statement, and that will hurt. But not uncommon for most banks right now. And so from the loan perspective, they've got a chart here, which is nice to see. Not all banks include this type of chart, but we can see which ones have fixed interest rates and which ones have floating rates, as well as what's the timing of the maturity. And if you were to consider everything that is fixed or floating, you would see that about 32% are fixed and about 68% are floating. So from an interest rate risk perspective, they've got a lot of their loans reprice quickly, which is great. So feel like more than likely their interest rate risk is going to be a little bit lower than most banks, since they have a lot that are floating rates, but also kind of a lot that come due. Even if they're fixed rates, they have 181 or 180 million that come due within the next year. So that adds to the liquidity as well. So I feel like their interest rate risk is probably going to be a little bit lower, but we'll be able to see the call report as well to see how does that compare with the timing of the repricing of their debt, as well as the derivatives that we were talking about earlier as well. And if we look at their borrowings, they got some FHLB borrowings, so 82 million. At pretty low yields. I like those yields. Those are really low yields. And then they have $80 million from the Federal Reserve Bank at 4.81%. It's pretty average yield as well. So we've got a pretty low amount of debt compared to most banks, I think. A little more favored toward deposits. But if we looked at the asset liability management, so this is intended to be, the repricing risk. They say that they're a little bit more asset sensitive, which means if, here it is, asset sensitive for year one and year two. So it means, if interest rates increase, they will be able to take advantage of their assets repricing at the higher interest rates sooner than what their liabilities reprice at, so sooner than the savings accounts and debt and all that stuff. So at least in the first year, which is really good for interest rate risk, I feel like. So as we talked about, it's due to most of their loans repricing. If you were to look at the call report, you would see that 31% of their loans reprice within the next year, and then 45% reprice in years 1 to 5. So, actually 76% of their loans reprice within the next 5 years. And so that gives them the ability to adjust the interest rates up if interest rates do go up. And then, as we talked about, they've got a pretty high percentage of their liabilities are non-interest bearing. So of course, those don't reprice because they don't have a price at all. There is the risk, I guess, that they migrate into yielding liabilities, but as it is, they've got a really good interest rate risk position due to their loans repricing pretty quickly. And then from a liquidity standpoint, we talked about they've got a lot of cash and a lot of securities, so I feel like their liquidity is in a really good position. They've got a little over 250 million of on-balance sheet liquidity, which would be the cash plus unencumbered securities, and so that represents about 13, a little over 12. About 12.5% of deposits, which is a pretty good ratio. That's pretty average. A little bit on the lower end of the average, but it's average. As we talked about, they'll have 31% of their loans perhaps repricing in the next year. So some of that will be maturities that are paid off and give them some more cash as well. So from a liquidity standpoint, I feel like they're in a really good spot. From a capital adequacy standpoint, we talked about when we convert things to fair value, they have a pretty good ratio of the fair value of equity compared to the fair value of its assets. So they've got a lot of equity that's supporting the assets of the bank, which is good. They can also borrow. They've got some of their securities and loans pledged to the FHLB and the Federal Reserve Bank, so they can borrow from them if they got some extra capacity to borrow from them if they need to. So I feel like the capital they have in place is adequate, and they're kind of slowly building it up from the deficit over the past couple of years. But But, if you were to look at these ratios here, I believe these are a little on the lower end of regulatory ratios right now. Yeah, just barely on the lower end. And that might be due to, a lot of commercial real estate loans being on their books, which, get a little bit of a more allocation toward risk than, for instance, 1 to 4 family mortgages. But, it's not below the minimum, well capitalized amounts. So, I don't think they're at risk for, being prevented from taking certain operational steps or, returning capital to shareholders or something like that. I don't think they're at risk for that, which is what would happen if they came below these regulatory thresholds. So I don't think they're at risk of that. I feel like they have a really good capital position, given some of the other normal non-risk adjusted ratios. And they've got some other ancillary, non-GAAP financial measures type stuff down here, which we talked about a lot of it, I believe. Return on assets, about 0.76%. Yeah, pretty low. Another thing to think about is they have a little bit of litigation ongoing, but it seems like the plaintiffs have sought, the plaintiffs being, or the defendant would be the bank, the plaintiffs suing for a little over $750,000, which isn't really that much money in the grand scheme of things. They've made $4.6 million of net income this year, but there was a motion to dismiss with prejudice. It's been appealed since then, but the footnote says that it seems like there's a remote possibility of things going wrong, but it does distract management and it does cost money for attorneys and stuff like that. So I feel like there's not a big risk here. It's basically some of the former shareholders suing over that owned the preferred stock that was converted to the common that during the IPO or sometime around the IPO, and they're a little angry about what happened then. But the bank, at least this footnote, doesn't seem to be too concerned about there being a material effect. So, but just something to consider, risk for sure. As we talked about, there's 573,000 shares that's been authorized to be repurchased. That's awesome as well, returning some capital back to shareholders. But that's it. So to recap things, from a profitability standpoint, we saw that the bank is a little bit less profitable than what the average bank is, mostly due to the net interest income being a little less, as well as, the non-interest income, being a little bit less as well. So we've got, a bank that's a little bit less profitable than the average bank. So from the risk side of things, the credit quality of the loan portfolio and the securities portfolio seems to be solid. Seems like they've got a really good conservative reserve in place, and for any possible loan losses. So I feel really good about the credit risk. Interest rate risk is another one that's really good. So they have a lot of loans that reprice pretty quickly soon. And so if the interest rate environment has gone up over the past year or two, so they should be able to capitalize in raising the interest rates on those loans, make a little bit more money. So that's great. From a capital liquidity standpoint, I feel like they've got adequate liquidity because they've got a good amount of cash, they've got a good amount of securities in place. And when you compare it to the deposits, they've got a pretty good percentage of liquid assets on the balance sheet compared to the deposits. So they're in a good position there. And, also what we might, from a capital standpoint, converting things to fair value and comparing the equity to the assets, they've got a good amount of, fair value net assets compared to assets. So, I feel like they've got a good amount of capital there. They can borrow some more from the FHLB and Federal Reserve if they want to. Maybe even go to the capital markets if they need to. And so I think they're well capitalized, in a pretty good spot, I feel like. So, all the risks that we just talked about fall in a comfortable range. I feel pretty comfortable of those. Pretty average risk for an average bank. The only thing is the profitability is below average. And so then, given those things, we have to consider, what is the market price relative to those variables, and currently the market price, the market cap of the company is about 250 million. Comparing that to the current net income of the bank gets us about 7.3% earnings yield, I think. So that's a really small earnings yield. I usually like to, currently we see somewhere between 9.5%, 11.5% earnings yield. So this bank's only yielding 7.3%, which is really low. Given that all the risks are average, I would want about an average earnings yield, and so it seems like the price for the bank is a little bit too high for what the earnings of the bank are currently. But if you were looking at, if you were valuing it based on the fair value of the net assets, you'd be getting a pretty good deal, because I think that was 1.77 times or so of the fair value of the net assets, which is average as well. So, but I think I would have liked the stock price to be a little bit lower. That gives me an earnings yield that's a little bit higher, that puts it in the range of what an average bank currently would be earning, which is somewhere between 9 and 12%, something like that. But that's not the case. So I'm going to say that we should not pursue this bank now, and maybe wait it out and see if the price can come down a little bit, and reconsider it then. But as it is, it's a really good bank itself. It's just I feel like a little bit overpriced. So that would be the only thing that's keeping me from buying it, is the price. So anyway, that's my thoughts on the thing, and let me know in the comments if there's anything that you can or that I missed, or that you think would be important for us to know or consider. I'd love to hear your thoughts about it. But thanks for listening.